They are panicking. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, a major country just did the unthinkable as they now are putting their entire banking system at risk. I'm going to show you what they did and why many other countries will soon have to follow suit. Let's go to Bloomberg, where we picked today's story up as we look around the world as German business outlook reaches 6-month high and signs of hope. And that's what every policy expert and political elite is looking for right now, is hope that the worst is actually behind us, that this downturn is going to manufacture out to be a soft landing. Now, one of the challenges in Germany is the manufacturing sector is in a depression. The government happens to be in complete denial here. So any hope that perhaps a bottom is in could mean big things for the country. The problem here is it doesn't mean things are actually likely to get better at all. Germany's business outlook improved for a third month in November, pointing to an impending recovery for an economy that's probably in a recession and beset by a budget crisis. So as we talked about on a recent show, governments are looking to borrow more money, but they have a problem. For heading into a recession, Germany's manufacturing sector already there. The problem now is you need to borrow your way out of it, but government spent so much money during the pandemic and they continue to spend after it when they should have cut their spending, perhaps even run a surplus to bring the debt levels down so they could stimulate into the next recession. The problem that these governments and political elites are facing right now is nobody believed the downturn would be sustainable. They believed it would just come as a soft landing and the economy would rebound. Challenge for Germany is their manufacturing sector isn't rebounding at all. The IFO Institute's gauge of expectations rose to a 6-month high of 85.2, and it's an index of the business climate also rose as well. And sentiment among German companies has improved slightly. And this is how much we're desperate for good news, is that any sort of hope, and it could be just a slight improvement in numbers, well, it gets people excited. The challenge is it's not going to pan out because the German economy is stabilizing, albeit at a low level. And that's one of the key factors here. You look at the global economy and it was overstimulated. And then everyone believed that that was the new normal, that it could just rise to this new higher level. But when you pull all that pandemic stimulus away, you get rid of all that monetary stimulus and everything's gone, you reset back down to the prior level. In fact, in many cases, you reset at a low level, with the problem is it's going to continue even further because there isn't going to be any rebound at all. Officials, including the Bundesbank president, Joachim Nagel, have even said that another rate hike might be necessary to return consumer prices to the 2% target, pushing back on market bets as a cut as soon as April. The reality is they're going to be cutting much quicker because where the manufacturing sector goes, we know the services sector follows. And the issue here the central bankers are betting on, and there's no way that the labor market is going to fall apart. But the moment you start to see layoffs start to pick up, well, the central bankers are going to be faced with an impossible task that they blew up the entire global economy, which is why as we look at what one major country is doing, you're going to see why Germany is going to be faced with it. And well, Japan, they're going to be faced with the same issue as well. As Japan's factory activity drops to 9-month low, adding to recession fears, and this is again what continued theme that we see around the world is everything, it came down, it's slowing down, and then it continues to go. Everyone thought this will be the soft landing, this will be the bottom, then the next month, well, maybe this will be the bottom. In Germany, they're hoping that this is indeed the bottom, but according to Japan, well, there's no bottom in sight yet. Activity in Japan's factory sector has deteriorated to the worst level since February, adding fears of a technical recession as of the last quarter of the year heads toward the end. And yes, technical recession because that means the labor market hasn't fallen apart. But just wait. The bank's Purchasing Managers Index of activity in Japan's manufacturing sector fell to 48.1 in November, remaining below the 50 mark that separates a contraction from an expansion. The reading in the service sector marginally improved, while the composite gauge fell 0.5 to 50, meaning unchanged from the prior month, the lowest level this year. So what you're seeing is the manufacturing sector Granted, it's a slow contraction, continue to shrink. You're seeing the global economy in Japan here, particularly in Japan, run out of momentum. And we see where the manufacturer sector goes, the services sector follows, and so too will the number of people losing their job. The data suggests, as we already know, that global demand remains sluggish while Japan's economy shrank more than expected in the third quarter, as domestic activity also remained lackluster. Amid a weak yen and continued inflation hitting households, some economists have pointed to the risks of the country seeing 2 consecutive quarters of contraction, entering a technical recession before we go into an all-out recession. Again, this is technical. The numbers just say we had a contraction, but look, the economy's okay because the labor market's intact, but not for long. As the PMI data showed, factory output and new orders fell again, with the pace of declines in new orders quickening, suggesting demand from the Western world is falling. The manufacturing sector, here we go, continued to shed jobs. And where the manufacturing sector, again, it leads the services sector. And when you have high-paid manufacturing jobs go away, then what you see is those people go on unemployment. Their income goes down. They have less money to spend in the economy, so demand goes down. And next thing you know, more people lose their job. But one thing that shouldn't be at a 9-month low, well, that's your trading account. We've got an update, by the way, Black Friday special, 5 coupon codes for a free month for CTA and Momentum Timer Pro. If you go to the checkout and there's no box to put it in, it's because 5 people beat you there. So get over there quick. Here, let's do an update on our S&P 500 trade. We got back in on this on November 3rd. Here you can see our machine positioning was at max short, and it came off of that on November 3rd. That is one of the 2 indicators we look for, and you can trade that just by yourself on this report, and you get it every day, and twice a week we put out a list of things for you to keep an eye on. That was on it. And now, on the same day, November 3rd, our technical indicator from Momentum Timer Pro. This thing looks at all those things like the MACD, the RSI, the Stoch, and all those other technical indicators, smooths them all out, and we had 1 daily count on the buy signal saying momentum had turned upwards on the daily. That triggered a buy it open right here on this little green candlestick here, buy it open. Many people said, hey man, this market's going lower, and so nope, the machine positioning and the technical said it was going higher, and sure enough, that trade, had you bought it at open following the reports, is up 5.1%, and now you can see why so many people using our reports are reporting just absolute success with their trades. They're saying it's easier, these reports are simple, and they're not that expensive. So again, check it out. You can get a free month before those 5 are gone, but one thing that's not gone is Japan's inflation problem. As Japan's inflation quickens, clouding price outlook for the Bank of Japan. Let's take a look at what's going on here, because consumption continues to be weak. So what happens is, as consumption weakens, inflation falls, because inflation, in terms of price, is just a proxy of demand. One of the challenges Japan is facing right now is demand is falling and inflation is rising. And many people think, this is the 1970s again. It's going to come back. Just hang tight. Japan's issues is not quite the same as the U.S.'s. And here we can see that companies are hitting the brakes on passing costs into food prices out of concerns over damaging spending, acknowledging demand is going down. A virtuous cycle of prices won't happen until wages rise more, and the BOJ isn't in a situation yet to normalize its policy easily. But guess what? Wages aren't going to rise here, because the issue Japan is facing is with their currency. As the weekend has been the key driver behind high import costs, it has stayed near a 33 low against the US dollar in recent months. And so now you start to get the issue here. If demand in Japan is going down, you don't need as many people working. The problem is you have an inflation issue. That inflation issue is coming right from the weak yen. And sure enough, if we look at the US data, we can get an idea of how this works. We have the import price index. This is all commodities coming into the US on a year-over-year rate of change. That in blue against the nominal broad US dollar index in red. And what do you see if the dollar weakens? And again, this isn't an every time scenario, but it's more to the Japan's issue because they import so many things. But you see a weaker currency, weaker dollar, higher import prices. You see it happen here post-Great Financial Crisis. Again, import prices rising. You see it coming out of the pandemic. Again, weaker dollar turns into higher import prices. Japan's issue is they import a lot of stuff, and this is causing havoc on their economy. But now, let's take a look at our headline story. Let's lead into what this country's got an issue with here. Why are we in Beijing today? Well, they're panicking in a big way. As China plans to buy pork for reserves, again, to stimulate prices. So one of the issues facing Chinese consumers is deflation. And we know that consumers love it when prices come down. Governments hate it because that means the economy is slowing down rapidly. As demand falls, that means incomes go down, more people on unemployment, eventually leads to more increases in delinquencies and then defaults in loans. That puts your banking system at risk. This is why central bankers and governments around the world do not want deflation. They know it's bad news. And here you can see China trying to stimulate. But this isn't the big thing they're doing. I just want to show you that their economy is slipping away. They're doing anything now to stop deflation. As China will again purchase pork from local producers and traders for the nation's reserves to try and boost alien hog prices as concerns mount over deflationary pressure on the world's second largest economy. Once you get deflation going through, consumers stop buying, everything comes crumbling down, including your banking system, and that's the forefront of China's problems. And I want to show you just how desperate they are and how much they're panicking. Of course, as you know, we said this would happen. As China races to end property panic, fill a $446 billion gap, if you can imagine that. Chinese leaders are making their most forceful push yet to end the nation's property crisis, ramping up pressure on banks to plug an estimated $446 billion shortfall in funding needed to stabilize the industry and deliver millions of unfinished apartments. Can you imagine? That is how much money that those Chinese property developers need to get back on their feet. That is a staggering amount of money. We told you if they go down, the banking system goes down. It will only be a matter of time before Beijing steps in. They started doing some things, and this one, wait till you see. This is completely unrealistic. It's unprecedented. We'll even go as far as saying it's unthinkable. As China's $56 trillion banking industry, see, I told you it had all about the banks, has already been battling with shrinking margins and souring loans as authorities have steadily increased pressure on lenders to backstop the economy and property sector. So you have two sides going on here. Lenders are saying, look, the economy's slowing, delinquencies are rising, defaults are coming. We need to batten our hatches down because we've got problems. We've got a lot of bad loans, and that means banks, in this case, don't want to put more loans on the books, particularly at a time when they know coming first quarter, they're going to do a lot of lending. Beijing says, no, we want you to front load some of these loans this year because the best way to deal with a banking crisis, just as we did here in the U.S., is paper over it, more debt. And China weighs the unprecedented builder support with the first ever unsecured loans as we now look at the unthinkable. And the reason, I want you to understand that the risks here are huge because if you paper over bad debts with new debts and then things go wrong again, well, now you've got a really big problem instead of dealing with it the appropriate way. As a part of a package of new measures to backstop the real estate industry, regulators are considering allowing banks to issue so-called working capital loans to some developers. This, unlike other types of loans available to builders that typically require land or assets as collateral. So this makes perfect sense. I'm going to build some property, so I get some land and I take a loan against it as collateral. Perfect. Or I'm putting a building up. I'm borrowing money against it as collateral. If I don't pay, you get the land, you get the building, you get everything. That's what the banks want. And that makes a lot of sense until now. That these loans that normally require collateral, the new financing facility would be unsecured and available for day-to-day operational purposes. So you want to talk about putting your banks at a major point of risk, making things even worse, because at least a bank could repossess that building or land, maybe take a loss on it. That's one thing. But an unsecured loan, the risks here are ridiculous, and this is completely unthinkable, but I want you to see just how desperate Beijing is to keep their property sector from annihilating their banking sector. Implementation would require regulators to exempt banks from being held accountable for possible bad loans. And you know what happens when bankers aren't accountable? Well, we do know what happens is they put out a lot of garbage, and then when things blow up, well, the bank fails, and all those executives walk away with fat bonuses. Given the high risk and the deliberations are ongoing and subject to change, the National Administration of Financial Regulation didn't respond for comment, probably for good reason. This is a good place to start to soothe buyer fears over unfinished homes that have been dragging on sales, and adding to measures would have been more effective if they had been rolled out earlier. Well, that's obvious, but again, nobody believes, this is key, nobody believes the global economy is slowing down. And Beijing and Germany are two of the biggest problems in the global economy. We can see the property sector here in China. We see the manufacturing sector in Germany and Beijing. They said we weren't going to panic. We weren't going to stop it. And we said, no, you will. You will. And you did. I would expect to see a sequential recovery in monthly sales after 3 months of implementation. I'm making the case, my friends, I think you'll agree, too little, too late. And I'm not the only one that disagrees or agrees this is a risky move. JP Morgan says, yeah, this is foolish. As JP Morgan says, unsecured loans to China developers, well, quote, risky move. Such a measure would be negative for banks as it would raise concerns about national service risk and credit risk in the medium term. So again, what if you go out and issue all of these unsecured loans? Remember, Beijing's telling them you're going to have to lend. And of course, if you're a builder and you need money and someone says, hey, you can borrow on an unsecured rate, you know they're going to do it. The banks can't say no. And if things continue to get worse in the global economy, if we don't see a turnaround, if Chinese consumers don't come out and buy homes, well, then the banks, they're toast. And that's a problem because implementation would be challenging as banks could circumvent such guidance due to credit risk concerns. Of course, the banks, their biggest risk they'd face is being completely insolvent and going under. And we already know here in the U.S., we have the small and mid-sized regional banks, they're insolvent. In Germany, manufacturing sector is in a depression. In China, you have the property sector getting annihilated and about to take down their banking system as the government steps in. And the reason I started the show out saying that other governments are going to step in and do the unthinkable is because when you see what's going on in China, you start looking around the rest of the world, as the global economy slows and starts getting mired in deflationary trends, well, governments are going to outright panic, and that's not going to be a good thing. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.